Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. On today's episode, there's a couple of things that we're going to cover up front, some housekeeping. And just to be clear, we're coming to you from Duquesne Hall right here in the heart of Foggy Bottom, Washington, D.C. Thank you to the Duquesne family. And I saw Rick and his family at the Yankee event in New York. Great to see you and great to see everybody. This is the kickoff to our third season of Market News with Rodney Lake, a show by the GW Investment Institute. A couple of things. Number one, I am grateful to all of our listeners. I am grateful for the people who tune in on the podcast, to the people who watch on YouTube. I'm so grateful for all of you. Thank you. Please keep tuning in and obviously tell others if you think this is useful. A couple of other thank yous. The people that make this show happen. So the people at the Investment Institute, Bojana Yankovic, Kathleen Henman, Danielle Lucero, Willow Rudden, they make all these things happen behind the scenes. And so if it looks like I'm prepared, it's because of them. If it looks like I'm not prepared, that's probably because of me. The people that run the studio, those gentlemen, Jeff Carpenter and Josh Waldrum, thank you to them for making things happen in the studio. We have a fabulous studio, the Duquesne family studio, and they do a great job running it. And to the manager of that, Susan Kopp, thank you as well. Really, it's a team of people that makes this all work. And so thank you to everyone. Thanks to the audience and thanks to the team that makes Market News with Rodney Lake happen. Again, this is the kickoff, the start of our third season. This is episode 51. Thanks, everybody. All right, what are we talking about today? So today we're going to be talking about a company. It's a portfolio company. It's not a big position in the portfolio, but it's an important one. And it's an important one, I think, for people to watch. The company is called ServiceNow. The ticker is NOW. And what they have been getting into is agentic AI. So some of the things that you should be thinking about is, artificial intelligence very broadly. And you certainly hear news all the time about ChatGPT, NVIDIA, which is our largest position, and we've talked about quite a bit, and we'll talk about again, don't worry. But some of the other companies that are in this that I think you should be paying attention to, one of those is ServiceNow. Bill McDermott runs this company. We're going to talk about the management, but they sell, to enterprises. They sell to companies that are trying to run their business more efficiently. They're trying to run their systems more efficiently. Their delivery is software as a service, so I think it's really important to understand the business model. But it's really important, just backing up for a moment, to understand what's happening broadly in this AI world and what's happening on the agentic front. So what's happening where people can deploy agents on their behalf and companies and get things done, especially in the background when you start thinking of large companies and you have big enterprise systems and you got to get data moved around, or if you got to get things done. These systems are going to help you do that. And so as your company grows, you're going to need better software, better infrastructure. ServiceNow is going to be one of those people that helps you do that. It's a powerhouse in the cloud software space. And obviously, it's been making big moves into AI, and that's why we're talking about it. And so this is around automation, automating tasks, automating things at work and workflows. And so these are the things that I think you should be thinking about as an investor, as an analyst, and as a business person. All right. So getting into it, let's talk about the business. And so let's start diving in. As a reminder, we're going to be using the GW Investment Institute framework, business, management, price, valuation, and balance sheet to analyze this company. And a reminder, disclaimer, this is for entertainment and educational purposes only. This is not investment advice. All right, so ServiceNow. All right, what's the market cap of this company? So let's get some basics around, okay, what's the market cap? This is a fairly large company, $200 billion. So it's not as big as the companies that we talked about and the Mag 7, where you're talking trillion, now $4 trillion for NVIDIA as an example, but $200 billion is a large company. And so this company has grown substantially. Bill McDermott has been responsible for a lot of that. And really, he's pushing this company towards AI. We'll talk about that in the management as well as the business part here. So, but let's get into the numbers. So when we talk about, all right, what's the numbers for this company? And so $200 billion market cap, what's the revenue for the company? So it's a software as a service. They're selling AI solutions to companies, cloud-based setup. What's the revenue? So the revenue, 11.5, we can say, billion as of March 31, 2025 for the trailing last 12 months for that period. And if you go back, and we always encourage our analysts and business people and our students who are taking our classes, it's important obviously to understand where they are currently. And really that's what you want to make sure you understand most completely is where they are now and where do you think you're going, because as an investor, we need to understand that. But it's also important to understand, well, how did they get here? And do you think they can either repeat or change course or whatever it happens to be? Obviously, a lot of times successful CEOs have, they leave those breadcrumbs so that we can understand, are they doing a great job? Are they going to continue to do a great job? And you can see it in the numbers. And if you look at what's been happening at ServiceNow, if you go back, all right, now the 2024 full year numbers, almost 11 billion, 8.9 billion the year before, 2022, 7.2, 5.8 in 2021. And so if you go from 21 to 22, I'm going to give the growth rate. So in 21, 30% growth in revenue, 23% in 22, 23% in 23, almost 24%, 22% in 24. And the year over year number through March is 21%. So pretty steady growth rate here. Obviously, it's come down a little bit. Hard to sustain 30% growth rates, but you're still 21%. Now, the projected, again, what as an analyst, as a business person, as an investor, what do we need to think about today and tomorrow? What's going to happen? The consensus number for the full year 25, 18%, and 18 for 26. So it's obviously coming down a bit. Again, hard to sustain those 20% year-over-year growth rates, but those are still impressive numbers. And so something to watch out for is, okay, what's going to be happening with that? Can they sustain this? Are they going to hit those numbers? So as an analyst, we have to pay attention. Again, this is a position in our portfolio, not a big position. Maybe we should size it up. Maybe we should keep it the same way. That's going to be for our analysts to figure out. And certainly as the fall semester gets started, our analysts will be working on that at the GW Investment Institute in our classes. All right, now let's look at what's happening. We're in the business part now. What's happening on the gross margins? So that's, the revenue minus cost of goods sold, things that are directly attributable to the business selling the goods. And so a little bit of accounting. As an analyst, you need to make sure that you understand some accounting. Make sure you understand what's happening with, what is the gross margin. And so when we look at this, it's how efficient, a demonstration of how efficient they are in the products here or the services. So let's talk about the gross margin. 78% gross margins right now. That is stellar, right? That is in the Visa, that is in the NVIDIA category. If you've been following the show and watching the show, you would know that this is exceptional, right? When you're in the 70s and you're at 78.9 right now in the trailing 12 months, that's exceptional. Now, again, go back. Is this a one-off? Is this something that they just produced this year? Make sure you understand where the company's coming from and where it's going. All right, where has it come from? So if you look at the 21, 22, 23, and 24, 77, 78, 78, 79, respectively, and then another 78.9, so about 79. Projection, again, where we are today, where we're going tomorrow, 81 and 81 for 25 and 26 consensus numbers. So it looks like they're absolutely moving in the right direction. The emphasis on AI important, and obviously looks like it's having a positive impact on gross margins. And we'll talk about some of the acquisitions in the management section here. So it looks like the way that they're growing the business organically and the way that they're doing their acquisitions is paying off in that gross margin number, both currently that they're able to sustain that and increase it actually a little bit. And the projection is to go a little bit higher. And going higher than 79 is really tough to do. You can only get to 100, right? And so if we look at this, that's great news. That is certainly something that we attribute to good management and to being in a good business. All right, so let's drop down to the net margin. So the gross margins are very impressive for ServiceNow. The net margins, on the other hand, are less impressive. And so the current trailing 12 months, when you look back through March and the last 12 months, the net margins are about slightly less than 14%. Those are not the software margins that you're thinking like, okay, we got 70, 5 to 80% gross margins. Maybe we should be getting 50 plus net or at least 30 plus net. We're in the, 14, like what's going on? So that's something. And as an analyst, like, okay, well, what's happening, with this? Where's the, why is there such a dramatic difference? And what's the, again, most importantly, what's happening from here? So, and if you look at, okay, well, what's been happening to the net margins over time? So, maybe they've been, plowing lots and lots of money and really there's nothing left back into the business. And again, as an analyst, that's something you have to understand. And let's look at from 21 to the current here. So you talk about 2021, 2, 3, and 4, you're at 4.2, 4.8, and then it jumps to almost 20, and then back down to 13, and then it's 13 again, almost 14 now. But the projected margins, which again, important to watch, going to 26 for 25 and 26 respectively. So that's fantastic, moving in the right directions, keeping those high gross margins, increasing those net margins. So it also could be a sign, well, the business is evolving, it's maturing, it's now having net margins, it's growing earnings, and on the positive side, on the net income. So now let's look at, okay, well, what's happening from free cash flow? So the other part for the business that we're going to be focused on, and obviously this is going to be interrelated to the balance sheet, what's happening on the balance sheet. Free cash flow for this business, you're talking $3.6 billion. So that's fantastic. And so really good free cash flow generation from the business. And okay, that's the March 2025 number. Full year last year, 3.4. And if we look back 21, 22, 23, and 24, 1.8, 2.1, 2.7, and 3.4 respectively. And so you've had really good growth of free cash flow. Fantastic. Good sign for the business. Good sign, really well run. And now let's jump in to the management. So before we move on, though, what should we score the business? Well, right now, the business is obviously, maybe it's not obvious, but it should be obvious from going over these stats that they're moving in the right direction. So if you didn't tell us that this was a software as a service business and this wasn't moving into agentic AI, and you looked at these numbers, you would still say, wow, this company has really impressive gross margins, it's growing its net margins, and it's generating good free cash flow. Those are all very positive signs for the business. Then they are moving into agentic AI. They are in a space, and they sustain these gross margins, and now they're increasing their net margins. So I think the business deserves an 8, and possibly better. But let's say an 8 for right now. And that can go up or down. You can be more conservative. But I think that's reasonable. All right, let's move on. So if we talk about the management, what's happening at the management side? So Bill McDermott is the CEO and has been since 2019. And he's a sales legend in the business, let's say. And he really had great success at SAP before that. And he's having good success at ServiceNow now. And so really important to look at his track record. What's he done at ServiceNow? He's been transforming into business, certainly pushing them into the AI world. And they're, again, an enterprise software IT player. And so they have absolutely been going much harder into the cloud and much harder into the agentic AI, automating processes, making companies more efficient, right? Your business is designed to deliver value to a customer. And if you can do that, you can get paid for that. They're absolutely doing that. How do we save money for our customers? How do we get their enterprise systems to be more efficient, to work with less people in some cases, or to do more with the same number of people in many cases also. So Bill McDermott doing a fantastic job, has been there since 2019. Now, let's just go over some more recent acquisitions. And so when we talk about capital allocation, obviously that's super important. They've been growing organically, and you can see that in the sales numbers, but also they've been growing by acquisition. So when we talk about some of the acquisitions, I think it's really important to think about, okay, well, what have they done? And what are some of the most important ones? And so I think the one that I think we'll just highlight, so they've done several, but they've really been doing these things in the AI space, and I think it's really important on the Moveworks. So that's the biggest one most recently, and that's certainly something that I think people should be paying attention to. And so the Move Forward acquisition happened just this year, and if you talk about what they paid for that, $2.85 billion, and it's a mix of cash and stock, and this really is helping them get more into the enterprise, automating IT, HR. And so this really continues to position them as this agentic enterprise AI software business for companies, making companies more efficient. And I think it seems like that Bill McDermott is doing an excellent job. Obviously, that's one example. There are others. And we could go over those possibly at another time. But Bill McDermott, really good track record at SAP. So far, great track record at ServiceNow. On the capital allocation side, I think doing a fantastic job. And so when you talk about, okay, well, what's happening there on the growth side, the acquisition side seems to be doing super well. They don't pay a dividend. So we talk about capital allocation, that's part of that. No dividend. This is a growing business. And they have been growing, and they're doing a great job with growing the business. And, tip of the cap there to Bill McDermott. Maybe you can be on the show, Bill. Please do. All right. So next up, but before we move on, let's give the score. On the management side, I would also say excellent, an 8 to Bill and company for doing an excellent job managing this business. Next up is going to be on the valuation side, and we're going to bring all the pieces back together too and talk a little bit at the end to wrap it up. But now we're on the valuation. So this is where there's a lot of criticism for this business. And so it's traded at a really big premium to the market for basically a long time. And so if you look at, okay, well, what's the forward PE? Again, we care about what's happening in the future. So as analysts, we're thinking about the forward PE, not the trailing, but what's the forward PE, because we care about today and what we think is going to happen tomorrow, and that's what we're paying for. So right now, trading at 58 times. That is not cheap, right? Certainly way more than the S&P 500. Now, you would say you look at the stats, this should absolutely be more. If the S&P trades at 23 to 25 times right now, does it deserve more than a double on that? Closing in on a triple? Well, I don't know. It's something to think about. But these transformative businesses are obviously going to get a lot of concentration, and so we have to understand that valuation, and we have to understand where do we think the growth is, and we have to make sure that our view of the market is okay. It's going to grow faster than what's expected. So if we look at those numbers on the revenue side, if we think it's going to go faster, and we think that those net margins can be better, well, we can pay the 58 times and still make money because the expectations are already built into those numbers. Now, if they don't do that, if they fall short of those numbers on the revenue side and the net income side, and why do I focus on the net income? Because that's really going to set the multiple over the long term, right? Why would people pay more for higher multiple rather for a company that has no real net income, right? Certainly in a short-term period when people have expectations, but over the longer term, those things are going to work out. And so you have to think about, okay, well, do I think that those things can sustain? And I'm willing to pay 58 times. And that's possibly going to be fine to pay 58 times. It can work out, but it is expensive. And that's one of the criticisms that ServiceNow gets, is that it's a fabulous company right now. It's really well run by Bill McDermott. They're in a great space, and they continue to moving in a great space. But lots of people know that, and that's reflected in these 58 times, the 58 times multiple on the price earnings. So something we have to think about. But let's look at it over time. Also, the same thing we talk about. Okay, well, don't look at just now, and certainly the forward numbers is where we want to do. Where has it been over time? Where has the market assessed this number over time? Just to get some context of where it's been. So the high over the last 10 years has been really high, 870. The low 76, and so it hasn't really traded super low. The average 309, and the median is 268. And so you're talking about super high numbers, right? And so if you look at it relative to its own history, it does not look expensive. In fact, it looks like, okay, fairly priced and possibly even cheap at 58 times. Now, can it continue to grow, right? It's a $200 billion market cap company. Can it continue to, have a higher, growth number in that revenue? Well, the projections, the consensus is that it slows down. Back in 2021, you're doing 30%, you're doing 21% in the last 12 months in March, and you're projected to do 18 for the next 2 years. Well, that's going to impact what we pay on the multiple side. So it's really important to think about that. It's really important as an analyst, business person, to investor to be thinking, okay, well, where do I think that's going? You got to make it up in earnings, or you got to make it up in the multiple, right? That's how you're going to get paid as an investor. And what's the earnings is set by the company, the multiple is set by the market, but the multiple is set by the company as well on how they're going to really, when you think about the gross and net margins, what are people willing to pay for those earnings, right? Price earnings. So the market sets the price earnings, but the company sets the earnings, right? And so when you think about the net income, can they drive higher net income? So when we look down here at the net income, that's what they call the bottom line, they're growing and projected to grow that. So the sales are coming off. And so the top line number is kind of flattening out right now. The growth in the top line number, not the overall, but the growth, the number is growing, but at a slower pace. So now we have to think, okay, well, do we think that's going to happen? So that is something as an analyst you really have to consider, you really have to think about. But paying 58 times may seem unreasonable to some, but if you look at the trajectory of the company and the space that it's in, possibly you're willing to pay that. We obviously paid it on the way in. And right now, we have to decide what we're going to continue to do with it. All right. So I think on the valuation side, obviously you're going to ding it there, probably give it a 6.5. You got to pay up, but it's a great company. And that's the case. So let's say 6.5 on that. So moving on to the balance sheet now. So if you talk about the balance sheet, it's another place where this is a really, a strong point. So you got $6.5 billion of cash and cash equivalents and about 2.4 in debt. So let's just round it, $4 billion in net cash, no problem generating $3.6 billion in free cash flow. So you're not really worried at all about the balance sheet. If you watched the blooper reel recently, thank you to Danielle Lucero who put that together. This will help us sleep at night. And so the balance sheet, we're sleeping like babies for sure on this one. No problems. They've been super responsible, about a 60 times interest coverage ratio. So EBIT, earnings before interest and taxes over interest, and generating, again, a lot of free cash flow. And they've been super responsible. Again, we said, look at this over time. The cash and cash equivalents has gone from $3 billion to $6.5 from 21 to 25. And the debt has basically stayed at the same 2.2 and year over year, about the same. Now it's 2.4. So in the net cash position has increased, free cash flow has increased, interest coverage ratio has increased. All those things helps us sleep at night. Again, sleeping like babies here with ServiceNow on the balance sheet. You can give this a 9 or even a 10 out of 10. Not worried at all. So we'll pull all those scores together. Obviously, the balance sheet's easy to do and fast when the numbers look like that. But we pull all those numbers together, you're going to get a high number, right? And so when you talk about the business is an 8, the management is an 8 or a 9. When you talk about the valuation being a little high, maybe give it at a 6.5, and then you give it 9 or 10 on the balance sheet, you're still talking, let's say, be conservative, you're going to come up with about an 8 number, right? Or 7.75 to 8, depending on how you come out on those scores. So this is a good business. Does it turn into a great business? That's something as our analysts need to watch for and look out for. That's what we're going to be doing this fall semester. We'll be watching ServiceNow. If you're going to be paying attention to ServiceNow, some of the things that I think you should be paying attention to, and we will as well, is what are they doing on the sales numbers? What are they doing on the net income numbers? And what are they going to be doing on the capital allocation, the growth, organic, and what are the acquisitions going to be? Pay close attention to Bill McDermott and what he is saying. Listen to those earnings calls. I encourage you to do that. We'll be doing that and doing our analysis, and our students will be doing great work this fall semester, I am sure. Thanks again to everybody who makes this show happen. That's a wrap for this episode. We'll see you back on the next episode of Market News with Rodney Lake. Thank you. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.